Dividend investors, bonjour. This is Mike Héroux, founder of Dividend Stocks Rocks and passionate investor. I'm here to help you invest with more conviction so you can enjoy your retirement. Last week, I have covered AT&T and I had lots of hate and lots of love for that company. I'm kind of like mixed feelings. And I thought, why would not do a video about the best telecoms company in the world, which are Canadian Telecoms. One of the reasons why they are the best for investor is because they are working in an oligopoly. So basically, imagine a playground where the three biggest players control 90% of the wireless industry. Even better, the wireless penetration of the population has been quite weak in Canada compared to other industrialized countries, so there's a lot of room here for growth. Even better than that, when you look at how fast we do, we have one of the best network. Well, this is possible because those telcos are making more money since they're working in an oligopoly. And if you're a Canadian like me, you probably hate paying your cell phone bills, knowing that you probably pay a lot more than anybody else in the world. But as an investor, this creates a great barrier to entry, and it's a great signal for dividend investors that can count on solid cash flow coming in every quarter. Now, you probably know that the Canadian government would like to allow more players on the playground and would like to have more competition on the wireless offer, but it is not that easy. So they're trying to favorite new bid for spectrum, so new players, and then they were ready to welcome Verizon a few years ago that thought of entering the Canadian market. But after further study, they realized that it would have been incredibly difficult to change Canadian habits of having their cell phones with either Rogers, Bell, or Telus, and they decided to do other transactions elsewhere, like buying back stocks from their shares in Vodafone, instead of entering the Canadian market. So it shows you how solid and almost impenetrable this market is. So today we're going to talk about the four biggest telco. I'm going to tell you why I don't like too much Shaw, why Roger has a very solid business model. We're going to discuss Bell's dividend safety because it's highest yield and probably the highest payout ratio as well. So we're going to look into that. And we're going to finish with Telus and its unconventional way to diversify its business model towards stuff that are not necessarily linked to wireless, and which I found very, very interesting. So let's start with the least favorite, in my opinion, Shaw Communication. Basically, Shaw Communication is a great dividend payer if you are looking for income. It pays its dividend monthly, shows a dividend yield over 5%, trades on both Canadian and US side, so there's a lot to love there. But as you saw my little sad face that I've played with the logo, and don't worry, I'm not going to do that often because I'm not very good with playing out with logos. I don't really like where the company is going, and I don't think this is the one that you should choose for your portfolio. So first, let's look at their business model. When you open their investors presentation, they look like they are well diversified between consumer, wireless, and business. But when you look and read actually the numbers, you realize that 68% of the revenues are coming from consumer wireline. So we're talking about cable and internet. Keep in mind that this company is first and foremost broadcasting cable company. So they're not necessarily too much into wireless. They only have 22% of the revenue coming out from the wireless. So it's not a huge stack. And in comparison, they reached this year the first time $1 billion in revenue from their wireless division, in comparison to Telus that is at $8 billion and Rogers that is actually over $8 billion. So it's a very small player there. They're trying to move ahead, trying to find ways to expand their business. And this is probably one of the problem with Shaw. Is what I usually like is to see a company that has a strong, solid background and have like a core business model that generates lots of cash flow and use that solid business to expand elsewhere. Similar to what Canadian Bank does, they're very strong on their market, they're protected by an oligopoly, and they're using that cash to expand towards new division like wealth management or capital markets or insurance, and some others are expanding their business in the US or internationally. So this is a good way to do it. Shaw is running a secular decline business with its cable industry. Thank God they have also internet, but I don't see this one moving forward and beating the big three. When you look at their dividend triangle, it shows that revenue is stagnating. It has went up a while because they're buying spectrum and they're expanding their wireless, but I expect revenue to go not too high. Actually, I don't expect much growth for the coming years, mostly because they're going to suffer from their cable business, and the wireless industry is going to be very rough for them. In terms of earnings, it's pretty stable. It's a little bit better than 5 years ago, but not incredibly higher either. And in terms of dividend, where it's a flat line, and you know me, I don't like flat lines. I don't like companies that are not able to increase their dividend. I always find that there's something fishy here. The explanation for Shaw, obviously, they want to invest more in their business into the wireless, but I don't see that as a successful strategy compared to the other big three. Finally, when you look at their payout ratio, you kind of understand, like, you know, at 90% payout ratio and 78% of cash payout ratio, there's not much room for increase. Cash flow is improving, so that's a good thing. They will need it, that's for sure. Don't forget, those kind of companies are still making a lot of money from cable. Obviously, they have like a bunch of subscriptions. It's coming in all like every month. So this is something to like. P ratio is very low compared to the others, as you will see in a minute. But the reason is growth vectors are minimal. They're like not going to be able to fight the battle for 5G as Rogers and Bell will be able to do it. And this is the reason why it is my least favorite telco. Now let's move to number 2, Rogers Communication, also trading on the Canadian and the US market, offering a lower yield, 3.3%. So you can already guess that it's more a play on growth than a play on income. But dividend growth since never, so they didn't increase their dividend last year. They don't have a streak for that. Pay quarterly as opposed to Shaw that is paying monthly. Let's dig into their business model. So in 2019, from their investor presentation, you can see that 61% of their revenues are coming from wireless, and you have 26 for cable and then 13 for media. So basically what they did, Rogers, is they went from their strong position in the cable industry and cable and media industry, and then expand rapidly towards wireless. They did that move a lot faster than Shaw, and this is why they are in a stronger position. You can see that it's highly profitable, because when you look at the adjusted EBITDA, it's like 70%, like 2/3 of their profit is coming from the wireless industry. Rogers, what they did is that they spend a lot of money on spectrum to make sure that they have like a dominant place, and they're doing exactly the same thing for 5G. They are investing massively for that. They want to be a big player, and they want to attract new customers on that basis. We're going to have the widest and the fastest network in Canada. Choose Rogers because we are making a lot of improvement in terms of technology. So Rogers has been doing well, good diversification between media and cable, as I mentioned. I like the fact that they control part of their content, and I also like the fact that they focus on sport. Why? Because it's a lot harder for streaming services to do anything when you have the license to show the Blue Jays games, right? The only downside about that is that they cheer for the Leafs, and as a Hab fan, I'm not too sure I could buy Rogers for that reason. But overall, I like the strategy. When you look at the stock price, though, it's not going anywhere. It's going up, it's going down. It is stagnating. But when you look at the rest of the dividend triangle, you understand why. Revenues are going down. earnings are going down. They obviously got hit by the pandemic last year. Media was not exactly thriving, cable industry either, and it's going to be a difficult year in 2021. Sports is coming back, but not as expected. Numbers for the Stanley Cup playoff were a lot weaker than usual, and those explain why the revenues are going down. But overall, I think they have still a growth vector with 5G and their wireless business. Looking at their dividend, I know you guys, a lot of you are looking at 3 years or 5 years dividend growth. Then you'll see a good growth, and then you thought, oh, maybe Rogers is a good candidate for my portfolio. But when you look at the trend, actually, there's only one dividend increase in the past 5 years. So you cannot exactly qualify Roger as a dividend grower. It is a bit disappointing, especially because it is paying a lower yield compared to the other telcos. Not too excited about it. When you look at their payout ratio, there's a lot of room to increase their dividend, especially compared to Shaw. And in a minute, you'll see that Bell is not in that situation right now. So 63% payout ratio, 50% cash payout ratio. The company could increase it. Why they don't do it? Mostly because they invest in their media content and they invest also into 5G. So they decided to go with a prudent approach, and instead of rewarding shareholders for their patience, they rather create value for them. I can't really be against creating value, obviously, but I prefer when a company can do both. So reward me a little bit for that growth as with dividend increases, and at the same time, if you are able to grow your business, that's a perfect thing. You can see that debt is growing. Obviously, for the 5G, it's quite obvious. Cash flow is pretty solid as well, so that's what we like. We like to see that is increasing. So overall, we can see that the business is healthy. They follow their plan. That makes sense. And their PE ratio is better than Shaw at 19%, but doesn't look like it is super expensive either, especially compared to the other years. It's pretty stable at the same time. And when you consider that earnings has been hurt by the pandemic last year, it could be a good timing to look into Rogers. The only thing I don't like, I'll say it again because it's super important for me, lack of dividend growth. Now let's discuss Bell, ticker BCE, trading also Canadian and US, offering a gigantic dividend yield of 6%. So income-seeking investor could be quite interesting. Even better, dividend growth since 2009. So this means that you're not only getting paid like a huge, super strong bond, but your payment is increasing every single year. So that's kind of interesting, but it's also a bit of a source of a concern for some investors. So let's dig into their business model to understand how they make their money. As you can see here, we have a business model that looks a lot like Rogers, with 53% of the revenue coming from wireline. Most of it is coming from broadband and TV, which is a good thing because obviously wireline voice segment is not going to grow in the coming years. I don't even have a wireline at home. We only have cell phones, and I think that this trend will continue to move forward. 37% on the wireless, so smaller than Rogers, still a good source of income right there, and 10% in media. So then again, they want to control a part of their content, which is also a good thing. They're going with some streaming services at the same time. Overall, I think it's a good strategy. It looks a lot like Rogers. So at this point, you will have to make a choice between growth, where Rogers shows like metrics that are maybe a little bit stronger there, but lack of dividend yield, or Bell that could be considered as what I would say a deluxe bond. So basically, don't expect too much in terms of price appreciation. You see over the past 5 years, it has been quite stable. Actually, you may lose money if you bought it at different time. Revenue has increased substantially, and then it's slowing down due to pandemic. Earnings, same thing as I mentioned earlier. It didn't help the media part. So what will interest most dividend investor is the last line of the dividend triangle, which shows a dividend that is increasing every single year. Now, the problem obviously is when you look at their payout ratio. ratio. 127, it looks like it's very high, and I give you that. First, don't worry too much about it. Look at the cash payout ratio, which is at 71%, so there's a big difference there. Then you're gonna tell me, yeah, but Mike, look at the debt. The debt is keep going up. It was around 20 billion 5 years ago. Now it's like close to 28 billions. And yes, it is high, and we're going to address that in a moment. And it is definitely something that you want to look for going forward. You want to make sure that you track that, because like $30 billion in debt is definitely a lot of money. At least cash flow is also improving quarter after quarter. And what you can see is the market is actually willing to pay a higher price in terms of PE ratio. So P/E ratio of 22 shows better appreciation than Rogers and Shaw. Is it because the company is paying a very high dividend and a lot of people are willing to pay for quality? Is it because they believe Bell will continue to thrive with 5G and their media content department? This could be a combination of both, but what's interesting is when you look at their cash flow, what you see here is free cash flow presented by the company. They generated last quarter 1.1 billion in free cash flow. You can see that their capex was also 1 billion. They have to invest massively, and this is a characteristic of this industry. It is capital intensive, especially if you want to go into the war for the best network, which Bell and Telus and Rogers keep fighting over that part. And you can see that there's a lot of money being invested there, but total dividend paid at the same time for that quarter was $785 million. So you can see here, you're getting pretty close to that 75% free cash flow payout ratio. Still able to, what Rogers are not able to do is actually grow the business and grow the dividend at the same time. In terms of debt, they are trying to be they're trying to reassure investors by saying, you know what, we are sitting on $5 billion in liquidity. We have plenty of money to do our projects and also deliver a good dividend. The solvency ratio is at 100%. So basically, they are well aware of their debt situation. It doesn't mean that you should forget about it, and it doesn't mean that because they have enough cash flow to pay their dividend that they should continue to increase it. I would treat BCE as a deluxe bond, meaning I would not expect too much on the stock price. So pretty much you buy it and then it's probably going to be stable. Maybe you're going to lose a little bit or earn a little bit, but on that part. But what's really interesting here is the 6% dividend. I don't see any potential here for a dividend cut moving in 2021. I wouldn't be surprised to have a very small dividend increase, though, maybe something like 1 or 2%. That would not surprise me either. Mostly because at one point you have to get the debt in control and you will have to pay that down. If they keep increasing their debt level, it's not going to be a good sign for investors and more people will leave the boat. So just take a good look every quarter. But so far, if I had BCE in my portfolio, I would be happy to get the dividend and I wouldn't worry too much. Now let's move towards my favorite telco in Canada. Actually, my favorite telco investment, period. Telus, trading also on both market, US and Canadian. Do not make the mistake of thinking that you're buying T on the US market, because T is reserved for AT&T, and then the US ticker for Telus is T.U. So very important here. T.TO for Canadian, T.U for US. Telus, in terms of dividend yield, is halfway between Rogers at 3.3 and then Bell at 6. We have 4.5% dividend growth since 2005, so the strongest dividend grower in the room. It pays quarterly, and it is the perfect balance between growth potential and dividend growth, and this is one thing I really like. If you're looking to make a play on wireless industry, Telus is probably your guy because they do not have any media division. Their business is all about wireless and wireline. In the wireline industry, you're gonna have a lot of cable and internet. Most of it is internet actually, and then you're going to have also some kind of like small division that are hidden that we're going to talk about: Telus Health, Telus Agriculture, and then Telus International. It's kind of funny because when you look at their reports, you can't find any signs of how much they make in revenue and profit. So you'll see acquisitions and debts related to those divisions, but it's unclear how much they make so far. So in the meantime, you can think that 2/4 of their profit is coming from wireless industry. The rest is wireline, and you'll have to wait to get a little bit more information because they intend to spin off Telus International, which we're going to discuss that in a minute. But first, let's look at the dividend triangle. You can see probably like the strongest revenue growth here, very stable, very going forward. Earnings has been hurt. Pandemic, lots of acquisition that has been made. They spent like 1.2 billion from the best of my knowledge to acquire AI firm for Telus International in 2020. So that obviously hurt a little bit the earnings, but I'm not too concerned. Actually, when you look at the stock price, this is one of the rare company that is actually growing over the past 5 years, which is also a good thing. And finally, the dividend, which is in very much good health. The management has reconfirmed its dividend growth policy moving forward, so they intend to go. It's actually more than 5% every year. From the top of what I remember, is like 7 to 10% dividend growth rate for the next few years. Very solid business here. They are thriving in the wireless business. When you look at their payout ratio, definitely under control. We're talking 70% for payout ratio and then 65% for cash payout ratio. A little bit of concern for debt. Debt is increasing from 12 billion to 19 over the past 5 years. You can see when you dig deeper that yes, they are obviously moving forward with 5G, so which requires a lot of money, but they also make a lot of acquisition to create Telus Health, Agriculture, and International. They have spent lots of money over the past few years in those divisions, and it's still unclear how it will grow in their business, but I expect that they will divide them and then be more transparent moving forward. Cash flow is improving, which is also a good news. When you're looking at a company like this, you want to make sure that the company is making the right move to improve its cash flow, so it will support the dividend. So it all makes sense. The narrative is on track here, and this is probably why companies, the market is willing to pay a higher payout ratio. Keep in mind, now it's at 25, but it's a little bit different when you look at it because the earnings per share dropped drastically in 2020. The situation should be resolved in 2021, so you can expect a lower payout ratio moving forward. You actually have a pretty good idea if you look at the forward payout ratio, which is at 19. So big difference here. So therefore, not necessarily a very bad time to invest in Telus, not this necessarily that overvalued as compared to the others. Now, I told you before, Telus is a strong play in the wireless industry. You can see that every single quarter they are increasing the amount of mobile user, and they also show the lowest mobile phone churn in the industry, which means that they're losing the less client. I know as Canadian we love to hate our cell phone provider because the service is not known to be incredible, but let's say that they are the best of the worst, if we could put it that way. And it is also very interesting to see that because I know Shaw is trying to target a lot of Telus customers in the West to attract them towards their mobile services. It may not be the best strategy because you're attacking the leader in terms of customer service, even if it's not incredible. Numbers are speaking by themselves. They show a very strong business model over there. I expect the 5G just to improve that. They have the will and the budget to also be a strong competitor in that place. But what is even more interesting in my opinion than looking at the classic wireless growth story is how the company decided to diversify moving forward. In their business description, they actually say that Telus Health is Canada's largest healthcare IT provider. I would really love to see how much revenue and profit it generates so far, but when you look at their financial statement, those information are not very clear. They also move towards Telus International, which focus on artificial intelligence, and Telus Agriculture, which are helping farmers using AI and technology to manage their crop and manage their land. When you think about that, pandemic is pushing the telehealth moving forward. So I think that betting on a company that is very strong from its wireless business, that is investing into other thriving segments, is a very smart move. We have discussed Telus Agriculture here. They have made lots of investment and they're quite secretive about what they do. From this article in the Financial Post, the management said that it's a sizable investment, so we don't even know how much they borrow and how much they invest into that. But we know they are making lots of acquisition and they're very serious about being a large player in the agriculture IT AI provider, if we can put it that way. So basically very interesting when you're moving forward toward thinking about the future. We all know that the size of arable land is limited. The population is growing, so managing your land and managing your crop is crucial. Entering technology in something that is so, like, excuse my French, but down to earth business is also highly innovative, and I kind of like this idea. And I'm going to finish about a very interesting note, because Telus told in 2020 that they will spin off their Telus International division. They focus on artificial intelligence. They previously sold 35% of TINT, T-I-N-T, which will become the ticker, back in 2016 for $600 million. So this would value that business at $1.7 billion as of 5 years ago. So you can expect quite a lot of value creation there when the spinoff happens. It is unclear how it's going to be and what will be the price so far, but you can expect lots of money to come into Telus business, which will be quite interesting for them because it will provide them additional cash flow to grow wireless agriculture and health. And at the same time, they will still benefit from TINT that will likely pay a dividend or something like that going forward. So basically, 3 great division to move forward. Amazing dividend growth, lots of potential moving forward. I love this company, and you can guess I have it in my portfolio as well. If you have liked this video, please give me a thumbs up. It helps my channels. Don't forget to subscribe. And if you want to learn more about where you should put your money for 2021, I have hosted a 2 hours webinar. So 1 hour presentation, 1 hour Q&A, answering maybe 40 questions from live attendees. You can register right there, or actually right here, link description below. When you register, you will see the webinar right away. It starts. The presentation was recorded on January 4th. I review all the sectors, telling you what has happened in 2020, what I think will happen moving forward, and I'm giving you a few tricks to minimize losses and dividend cuts in your portfolio as well. I think it was my most popular webinar so far. Over 2,000 people saw it already. So welcome to Dividend Stocks Rocks. Welcome to my next webinar. And until next video, stay invested.